A Random Walk Down Wall Street is one of my favorite books on efficient market theory because it slams institutional investors who charge fees on their clients. In fact, it said that a blindfolded monkey throwing darts at a newspaper could pick stocks just as well as these professional investors. And if that isn't the biggest call out ever written against professional stock pickers, then I don't really know what is. Hearing about this for the first time, you might think it's not only rude but completely wrong, because after all, people are able to make rational choices, and picking the most rational option based on future prospects would logically make it possible to outperform a monkey throwing darts. Additionally, you can look at previous performances on hedge funds and mutual funds to see that every year there are, in fact, some that outperform the general market. In general, the two biggest theories on evaluation of stocks is determined by either fundamental or technical analysis. We'll start by talking about fundamental analysis. This is the analysis focusing on the company's balance sheet, cash flow, and income statement. And this includes people like Benjamin Graham, Warren Buffett, and Peter Lynch. This book, A Random Walk Down Wall Street, is controversial because it's saying that efficient market hypothesis shows that even these people are just the lucky few who outperformed by chance rather than their actual analysis. I know this sounds ridiculous for investors who follow these people, but we'll get into why efficient market hypothesis says this later in this episode. The second most popular method of analysis is using technical analysis to determine stocks to pick. Technical analysis means using the stock's price chart to determine patterns and use those patterns to project where the price of the stock will be to obtain returns greater than the general market. Again, efficient market hypothesis showcased in this book would say that investors using this method would also simply be lucky if their choices obtained greater returns than the general market. But why would this book call out the two biggest ways to analyze stocks, and what justification does it have for doing so? We'll start with fundamental analysis. Number one, the possibility of faulty information. This is also an issue brought up by Benjamin Graham in Security Analysis and The Intelligent Investor. When it comes to finance, there are many ways to manipulate the numbers and appear to be a better company than you really are. Number two, if you have a complicated array of variables you're filling in to run value calculations, then there's a possibility you'll either do your math wrong or overestimate or underestimate a future value. And number three, lastly, there is the simple fact that events in the future are unknown. When doing any of these calculations, you're taking previous performance based on events that already happened. Catastrophic future events like pandemics can completely derail any calculations that you previously made. Next is technical analysis. And the number one biggest issue with technical analysis is it's self-defeating to follow the crowd's consensus. It simply leads to the need to anticipate what others are waiting for. For example, look at a falling wedge pattern. General consensus is that this is a bullish signal to buy. The issue is that people are using technical analysis are already aware of this signal, so they want to buy before the other people buy to get it cheaper. But that would mean buying before the signal was completed, thus not giving you a proper signal. Number two is sharp spikes in prices. This is true now more than ever with the internet and high-frequency trading. Being an ordinary investor trying to watch stock prices and buy based on signals and new information is almost impossible. And number three is the greater fool theory. The idea that regardless of the price of the stock, there will always be a greater fool to buy it makes it a horrible investing practice. Eventually, there will be no one else who will want to buy the trend, and then it will leave whoever the buyer is currently being the bag holder of the losses. But perhaps worst of all, the issue with people picking stocks is that they are human, and humans have emotions which can control the choices that they make, rational or otherwise. This means that even if you had a rock-solid theory for market returns, you might not be able to go through with it due to emotional stress. This is especially true for retired people using these investments to live with, or investing firms where their credibility is on the line. Here are the three most common issues caused by humans when picking their own stocks. The first of which is overconfidence. Here's a picture of the Dunning-Kruger diagram, and put simply, it might be the case that a person will have vastly more confidence in their abilities than they have experience to back up that confidence. Having vastly more confidence than experience means that devastating mistakes might take place, and images of extreme loss can be seen all the time from people misinterpreting their abilities and taking more risk than they should have. The second is herd mentality. This is when, despite what you personally think, your choice or perception gets altered because everyone else says something different. Investors during the dot-com bubble will remember how following the idea that valuations were okay because the internet will allow for greater growth got burned from following the herd opinion. Number 3 is loss aversion mentality. Perhaps a person can logically understand that the odds are in their favor, but the feeling of losing what you previously had is greater than the potential gain feeling of what you could have. Logically, these are odds that are favorable to play. However, human mentality would often make people not want to play this. In fact, most people will only play this if the odds are more than double what they could possibly lose for their payouts. So this book is slamming the capability of humans to pick stocks and generate better returns than the market average. But the question is why? And the reason comes from the random walk and the efficient market hypothesis. The random walk theory comes from the idea that stock prices of past cannot predict the future performance because of the randomness and changes. It's effectively like the pathway of a drunk man walking down the street. He has an intended destination in a general direction, but the past pathway that he was taking is not indicative of the next few steps that he theoretically could take. A random walk theory for stocks means that, if this is true, technical analysis is a waste of time and should not be used, because after all, the past is not indicative of the future. So that was the random walk theory, but what about the efficient market hypothesis? This is the idea that the price of the business, which is being shown in the stock's price, is reflective of the information available to all people looking to buy or sell it. Thus, the idea is that if there's all this information available to people, then it would not be possible to outperform the market with expert stock selection or market timing, but instead by taking on more risk for the possibility of greater return and getting a lucky outcome. What would these two things being true mean? Well, if random walk theory is true, then that means that technical analysis is a waste of time because, after all, if this is random walking, then why would looking at the past prices to determine the future outlooks make any sense? Additionally, if efficient market hypothesis is true, then why bother looking deeper into the fundamentals of a company if all the publicly available information is already priced in? There is sure to be criticism towards both of these theories on whether they are true or not, but what is really confusing is to some how they could possibly be suggested as happening at the same time. If there really is a random walk, then how does that work in combination with a totally efficient market where available information is already priced in? This is by far the biggest criticism, and many hedge fund managers say that they are contradictory of each other. Before continuing to the end of the video, if you liked the video so far, consider subscribing and leaving a like. And what's your opinion on random walks and efficient market hypothesis? Do you think that they are present in the stock market or totally bogus? Well, assuming that both of these are present in the market, which this book does believe exists, how would anyone be able to beat Wall Street? The end game for this book is to tell people that if you want to have decent returns in a market where the only way to outperform the market is through randomness or taking on additional risk, then the logical conclusion is that you should stick your money in low-cost index funds. The reduced cost of fees will generate better returns than the theoretical returns of letting someone else or yourself pick your own stocks and manage your money. Let me know what you think about random walk theory and efficient market hypothesis discussed in the book, and thank you all for watching.